One of the most asked questions we get is, what is a DSCR loan? Where does it fit? What can we do with it? So first of all, a DSCR loan is a loan made just for investors. It's investor loans only. It is never used for owner-occupied properties. The best feature of a DSCR loan is that it does not use any personal income. So no tax returns, no W-2s, nothing from you personally. It's all on the property. If you're new to my channel, hi, I'm Mike Bonn. For the last 23 years, I've helped real estate investors get the best funding that's out there. Today, we're going to go over DSCR loans, why it's good, where it's good, and where you should never use it. So first of all, DSCR, which is debt service coverage ratio, hopefully you never have to know that again, just go by DSCR. It is a replacement. It is another product you could use for funding rental properties. It is just like a conventional loan, a bank loan that has many options. It's a 3-year, it's a 5-year, it's a 30-year, it's a 40-year. Whatever you're looking for, they have DSCR options. So DSCR, like I said, is a long-term option for your funding of rentals. What it's not is it's not used for fix and flips, and we'll go through that later in this video. Let's go through what DSCR is, what its benefits are. The biggest benefit of DSCR is it has no personal income requirements. So no income taxes, so if you're writing everything off, no problem. No W-2s. It doesn't even matter if you have a job because they're not going to ask you for that income. They also don't care how long you've been in business. If you go to a bank or a conventional loan, they want to make sure your business is established for 2 years or more, and they want to see those tax returns. DSCR, like I said, it does not matter if you just started your business yesterday or maybe don't even have a business set up. DSCR is not based on your personal income, but what it is based on is the rental income from that property. It's not the portfolio or all your properties, it's just that property. And what the underwriters are looking for, does that property break even? Does the rents pay the expenses? And their expenses, when they look at it, they consider expenses the mortgage payment, the taxes, the insurance, and if there's any HOA. At this point in time, they don't get into property management or repairs or anything else like that. They just care that the rent pays for the critical things. Now, the minimum threshold for DSCR, what they call a DSCR ratio, that's what everything is based off of, is they want a DSCR ratio of 1. That means your income matches your expenses. So at least you're breaking even. You know, as an investor, you probably want it to be more than break even. So you want a DSCR ratio that is higher than 1. And so do lenders. They look at it like the higher the ratio, the more likely you're going to keep making payments because it's cash flowing, it's bringing in money, it's never going to require money out of your pocket. Now, the higher the DSCR calculation, the better for you, the better for the underwriter. If you have a DSCR calculation that's less than 1, there are programs out there, your terms are going to be a little less, they're going to have less on the loan to value. Rates, of course, are going to be higher, but there are options for you when those properties do not cash flow. That comes in handy when you have a flip that maybe is not selling and you need to put it into something, and maybe a rental, like a negative DSCR or a no ratio loan will work perfect for you. If you find this information helpful, hit the like button to help other investors just like you. Now, just like other loans, DSCR also has requirements for credit. They are looking for people who have at least a 660 and above. Of course, the better the credit, the better the LTV and rates you'll get. Anything in this market being early 2023, anything above 700 is really where you want to be. So the better the credit, the better the terms and rates. But always check around because a year ago, you could get DSCR in the 600, even 620 mark. So always check where your market is at this time. But credit is a major issue when you're looking at DSCR loans. Besides credit, they're also going to look at loan to value. There are projects out there that they'll lend up to 85% of the purchase. The standard in DSCR is somewhere between 75 and 80% on a purchase or a rate and term refinance. So if you go above 80 into 85, once again, expect to pay higher rates and maybe even higher fees. So we have credit, we have LTV just like any other property. In DSCR, it's also based on type of property. Unlike conventional, it'll only go up to a 1 to 4 unit. This will go up to 8plexes and some will even go larger. They will do mixed use. They will do a little different than some of the conventional, more like what banks do. They'll look at each property. But DSCR does have issues with locations. They're looking for properties in major metropolitan areas. So some of the smaller communities, some that are less than 25,000, have limited supply of DSCR lenders out there. Now you know the 4 things. I mean, it's based on the property's income, not your income. It's going to be based on your credit score. The better your score, the better your terms. It's going to be based also on loan to value. So the lower the loan to value, the better, once again, your terms, your rates, how you qualify. And it's also the type of property and where it's located. But there are other positives and negatives that we're going to go over for DSCR, just so you know where it fits. Like I said, it's just a loan that can be used for rental properties, just like conventional or bank loans. So remember, the positives for DSCR is it's not your income, it's the property's income. So it does not matter if you have a business, if it's seasoned the 2 years, if you write everything off in your tax returns, it does not matter. It does not matter if the other properties are not cash flowing, as long as this one does. Another positive, unlike conventional, is you can buy it in an LLC or a company. They actually prefer that, so you don't have to have it in your personal name. You could put an LLC around your property just to protect yourself, and you could close it with this kind of loan. There's also many options out there. They have an interest only, so to keep your payments low and even help you qualify. They have a 30-year, they have adjustable rates like a 3, 5, and 7-year, but they also have a 40-year. So your standard that most people are looking at now is your 30-year fix, just like everything else. Your 40-year fix, which just takes it out a little bit longer, but is still paying down. And then your interest only, which for the first 5 to 10 years, you're paying interest on the principal, not the principal. And finally, one of the best benefits is it works great with BRRRR. So if you're finding something and you want to flip it into a long-term loan, DSCR works perfect for that. Now let's look at the negatives. Where doesn't it stack up against these conventional and bank loans? I think the number one thing is rate. Typically, if you're looking at a DSCR loan compared to a conventional loan, you're going to find it somewhere between 1% and 3% higher than a conventional loan. And why do I say 1% to 3% higher? Because unlike the conventional market where it's controlled by 2 pseudo-government agencies like Fannie and Freddie, DSCR is made up of hundreds of different investors who come up with these products. At one lender, you may find a rate at 6%. The same client at another lender may find 8 or 9%. You have to shop around. You have to look at what's out there. It is so segmented that you're going to have to do a little bit more work to find the best deal for you. Also, it has prepays. The majority of these loans, unless you're in a few states, have prepay penalties, which means if you pay it off early, somewhere between years 3 and 5, they're going to charge you a fee, an exit fee. It could be anywhere between 3% and 5% of the principal balance. If you're looking at something that you want to maybe sell in the future, DSCR may not be your best option just because of the prepay that is when you exit the property. These are made for investors. So if you do not own a property now that you live in, an owner-occupied, a primary residence, typically you cannot do a DSCR loan, because what they don't want you is using a DSCR loan to buy your primary residence, because these are business-based loans. So they're not going through TRID and some of the other requirements. So the third negative is you have to own a property yourself and live in it to get a DSCR loan. Another negative is it's based heavily on credit scores. If you do not have a great credit score, you're going to maybe be kicked out or kicked into higher rates. And lastly, smaller communities. We deal with a lot of smaller communities and investors in smaller communities. These DSCR loans do not always work on smaller loans. Typically $75,000 is the smallest loan they will do. But they're also looking at communities that are larger than $25,000 to get where you can shop around, look for different kinds of lenders out there. Remember, there are some positives, there are some negatives, but DSCR loans, when they're used right, are perfect for real estate investors. Just a couple other things you should know about DSCR is, number one, you can use them for long-term or short-term rentals like Airbnb. If you are using them for short-term, especially in the market where there's more inventory coming on than people renting, they have limited your LTVs. So instead of maybe an 80%, it may be 75 or even 70% on the short-term rentals. Also, something you should know is that you do not have to have the property rented to actually use it to purchase or refi, because you could be just in the middle of maybe working on it, or you have a lease in place. As long as you have a lease in place, you could get a DSCR loan. You also need to know that DSCR works for purchases, rate and term refinances, and cash out. So no matter what you're doing for your rental property as far as your funding needs, DSCR can help you. You need to know when you're looking at DSCR, you need to shop around, because as I mentioned before, this is a segmented business. You could shop and find 3 different rates from anywhere between 6% and 9% with the same credit score, the same property, in the same area with the same rents. You must shop around. So if you want to shop around, reach out to us. We work with 10 to 15 different DSCR wholesale companies just to make sure we can find the best rates, the highest loan to values, the lowest credit scores, whatever it may be. If you want to find out how to figure out your DSCR ratio, we have a video and we'll link it below. We have a great download below, a DSCR calculator that you could use for free. If you want to keep making more money in real estate, we'll see you on the next video.